Welcome friends to this new video of Sapphire Talks English. In this video we shall discuss the impact of the Iran war on the US economy. In this series of the economic impact of the Iran war, we have already discussed its impact on the Indian economy, on the UAE economy, on the Eurozone as well as the UK economy. In this video we shall focus on the impact of the Iran war on the US economy and what the prospects are looking like for the US economy. Friends, first and foremost, we must point out here that the United States is mainly a consumption driven economy. By this, I mean that most of the goods that the US economy is consuming are produced outside the geographical boundaries of the United States. What the United States majorly produces is basically arms, armaments, and defense related products, as well as it does produce a lot of high tech products and a lot of crude oil as well as natural gas. But other than that, a lot many items that the American consumers are habituated to consuming are coming from outside the United States. So although the United States itself is geographically removed from the war zone, the countries from where its goods are coming have to pass through the war zone or they are located near the war zone. The important factor to note here is that on account of the Iran war, the crude oil prices have been fluctuating, but the general trend is towards increase. The result is that the cost of production as well as the cost of transportation and logistics all have gone up, with a resultant supply side shock for the US economy. What I mean by the supply side shock is that because of the rising cost of production, the prices are going up for most goods in the United States, and in some cases because of the supply disruption, some goods are not available at all. Although the non-availability part is still very much under control, definitely we can say that the prices are definitely going up in the United States. Now, when there is an inflationary pressure within any economy, be it the US economy or any other economy, that country's central bank is not able to do much in terms of reducing interest rates or taking any other monetary or fiscal measures to induce growth, because generally growth and inflation, they move hand in hand, which means that if there's a larger growth percentage, there's a good probability that inflation would also go up a bit. So this has resulted in a situation where the US Federal Reserve is not able to decrease interest rates, cut interest rates to boost the US economy, simply because there is already enough inflationary pressure within the US economy, and the Fed cannot actually cut interest rates and risk adding to this inflationary pressure. There is a fundamental principle in economics, which is that as prices increase, the demand decreases. Now, on account of the inflationary pressures caused by the Iran war, it is seen that the US business sentiment has slipped to an 11-month low in the month of March 2026. Most of the businesses reported a weaker demand for their products, lower business confidence, as well as higher selling prices across the board. Sectors which are most exposed are the transportation sector, travel sector, retail sector, and those manufacturing sectors which are energy intensive, that is those sectors which consume a high amount of electricity. Because of the pre-existing inflationary pressures in the US economy, the Federal Reserve also finds itself tied down. Had the inflationary pressures not been there, the Federal Reserve would have definitely cut interest rates in order to boost the economy. But with inflationary pressures already existing, the Federal Reserve now cannot think about cutting the interest rates and making money cheaper and adding further to the inflationary pressures. Therefore, the Federal Reserve has categorically said that at least for the coming 6 months, they do not plan to cut interest rates and increase the flow of funds in the US economy. There is a lot of volatility in treasury markets across the world, including the US treasury markets. The reason for that is now investors are moving quickly between safe haven investments which do not offer a good return, as well as other investments which are less safe but they offer a better return. Because of this, there is a high volatility in treasury markets as well as stock markets across the world, including the USA. Now, if oil demand stays high, the prediction is that USA will definitely face slower growth like the rest of the world. This is because although the US is geographically far away from the conflict zone, its economy is as much enmeshed with the global economy as anybody else's. There will also be stickier inflation and weaker consumer as well as business sentiments. Now, friends, if there's anything new that comes to my notice regarding the economic impact of the Iran war, I'll definitely make a new video for your benefit, and definitely I'll get those issues in front of you. Till then, I bid you goodbye. If you have found this video interesting, please like this video, subscribe to our channel. Till then, I bid you goodbye. Jai Hind, Jai Bharat, Vande Mataram.